Hello, welcome to the March 2019 edition of Tax Talk. My name's Anita Monteith, and with me today I have Jane Moore, who is editor of TaxLine. Hello, Jane.
Hello. And
Frank Haskew, who's head of the tax faculty.
Hello, Anita.
Hello, Frank. Now, we're going to be talking about some of the content of the spring statement. We'll also be talking about some year-end tax matters, and of course, inevitably, there will be one or two Brexit points. But we're going to start off with the spring statement. The Chancellor read his spring statement on the 13th of March. In fact, he didn't read quite all of it, I think. He's sort of stopped part way through. But nevertheless, we've been studying the paperwork that came out with it, and we have some interesting pointers for you. Now, Frank, were there any tax changes in the spring statement?
Well, he has, of course, said that he was moving to a single fiscal event rather than two that were introduced by Gordon Brown. And he is coming good on his word.
Yeah, he's stuck to it.
He is sticking to it. So, I mean, I think there was a bit of a feeding frenzy as usual as to there are going to be loads of tax changes. I mean, there were a few announcements, but effectively it was devoid of tax changes. But, I mean, just quickly on the... he's responding to the Office for Budget Responsibility statement, and just quickly on the figures. I mean, of course, we don't have a red book now in spring, but he had a bit more money to play with. Although growth was down, tax receipts were actually up, and debt interest was lower. So we had the figures were better than last time around by about 2.7 billion. But of course, his commitments were already, he's snaffled most of that already. So, you know, a reasonably improving picture. But as we all know, there's an elephant, which we open the door, occupies the room, I think, at the moment.
Yes, we are, of course, talking about Brexit, but we'll come on to that a little bit later on. There were some pointers announced. Should we just mention Making Tax Digital very, very briefly?
Oh, I think we have to. Brexit and Making Tax Digital. We always mention
two
those
topics, I know. Okay.
Yeah.
Well, let's do a little bit on MTD. Some people had been suggesting that it was going to be deferred. We haven't seen a deferral.
It's very unlikely.
We didn't really think that would happen, did we? And the latest stats are that nearly 50,000 businesses have signed up to the pilot. Of 1.1 million, could have hoped for more.
Yeah, slow, isn't it?
It is, slow take-up. And, of course, 1st of April is start date, even though a lot of businesses won't be filing the first VAT returns until August under the new rules.
But they will need to have their record keeping sorted.
Quite. There was a restatement of something that I think we knew already, that HMRC would adopt a very, very light touch in this first year. So no penalties except, of course, the
default surcharge, which is the same as it ever was.
Yeah, and you avoid that simply by paying the VAT.
Yes.
So more on MTD, and you will be able to see more from the tax faculty on Making Tax Digital. We've got a couple of webinars lined up for early April, and I'll talk a little bit more about how you can avoid missing those at the end of today's
Tax Talk. While we're on MTD, though, just worth mentioning that they did confirm that there wouldn't be any new taxes or new businesses brought into MTD compulsorily in 2020. So they're going to let the system bed in first.
Yes. So we think probably income tax won't be affected until 2021 at the earliest.
Earliest, yes.
And corporation tax, still no sign even of the consultation.
I was to say, that's not appeared, has it?
No. Nobody's mentioned corporation tax now for quite some time.
But we were calling for it not to be in 2020, weren't we? So that is actually a welcome statement.
Yes, so actually a very soft landing and an announcement about the income tax start date, both of those to be welcomed.
Yeah.
Well, certainly much saner than the first ideas for MTD however many years ago it was.
Yes, and actually we have actually seen quite a lot of sanity being put into the programme. But Jane, there's a bit more, isn't there, in the
Yes, there was a written ministerial statement which came out at the same time as the spring statement, which runs to 7 pages There's a lot on tax, but mostly listing things that are going to be published but haven't been yet, many of which we were expecting. There's a welcome one on VAT. The government's going to look at simplifying the VAT partial exemption and capital goods schemes for businesses, which is one of the things that the Office of Tax Simplification identified when it had a look at VAT a couple of years ago. So that's good news. What else is coming up?
Well, actually, while you think about that, of course, VAT and making tax digital, we really need simplification for partial exemption, because it can't ever possibly work with a partial exemption break in the digital chain.
So perhaps it would have been nice to have looked at this even sooner.
Well, indeed, but better late than never. We've got the Structures and Buildings Allowance.
Ah, yes, that's the other big thing that actually was published on Spring Statement Day.
Yes, and that's one of my favourite.
I was going to say,
yes, we're going to take a back seat while you do that one.
Now, before you get too excited, there were no guidance notes published. So what we have got is the draft legislation. And as I haven't yet had time to read all the draft legislation, I can only tell you one or two of the headline changes and where I think the excitement may lay in the detail. First major headline change is disuse. Now, the original proposal was that if the property went into disuse for a couple of years, you'd continue to get your 2% writing down allowance, and then after that, you wouldn't. But that gave rise to quite a few complications, many definitions and problems about partial use of buildings and so on. So that provision is not going to be taken forward. So if the building falls into disuse, you will continue to get the SBA regardless. Where we do still have perhaps a challenge in some of the computations is where the building changes hands. So fair enough, if it changes hands, the new owner is going to take over the remaining Structures and Buildings Allowance for the rest of its life. But those of you who have long memories and think back to good old exam questions will remember one of the favourites was always grant of a lease. And of course you can imagine that if you grant a lease on one of these buildings, there will be rather more to consider for your SBA. Is
this in regulations, is it?
It's in the draft regulations. I think for the beginner, you may want to wait until somebody has analysed the draft regulations.
That would be you then.
Yeah. And then that person publishes a little bit more explanation.
We're planning to publish a news item on our website about that. And it's out for consultation, of course, this legislation, isn't it? So I can't remember what the deadline for comment is.
It's quite short,
quick, isn't it?
It's quite short because they want to get the legislation passed as soon as possible. So for all you techies out there who love an SBA, do please ponder the draft legislation and let me have your comments as soon as possible. Moving on down the list, we've got the National Insurance Employment Allowance.
Oh yes, we're back to the list of things that are going to be coming out. And these are regulations on the National Insurance Employment Allowance, which is going to be restricted to employers with a NICS bill below 100,000 per annum, essentially.
Seems sensible, actually, just to target it.
And the change from 2020, if memory serves, and we're going to see the regulations again. They'll be for comment when they come out.
Right.
What else we have? This will be an interesting one, yes. Private residence relief, announced in the budget last year that there would be restrictions to that, including the final period of exemption coming down to 9 months, shortest it's ever been, I think. And also a restriction on the lettings relief rules. So that's another one that we will await and which we'll be keen to get comments on when it appears. Yeah, so
this is really a reduction in the availability of the principal private residence exemption, isn't it?
For CGT.
Sue Moore is going to be looking at that, so I'm sure she would be pleased to receive comments from our viewers. Frank, you've been looking at some of the avoidance and evasion.
Well, that was the main sort of material, if you like.
Certainly in terms of length.
In length,
Yes.
in the, I was going to call it the budget, sorry, the spring
I know,
statement.
it's really
Spring
hard.
statement.
I want to keep calling it the autumn statement.
I
So,
can
budget
imagine.
report.
right, Jane, you just keep correcting us. Spring statement.
Spring statement. So, yes, there were two new papers the government published. One on, believe it or not, tax avoidance and evasion.
This is how to do it.
No, it's like a 68-page doorstop of a report. When you actually look at it, though, there was very little actually in it that was new. In fact, there wasn't really anything.
They've produced similar papers before,
Yeah.
and it just reiterates some things we knew.
Yes, so, I mean, effectively it stated what the government have been doing. And in fact, Annex A, it lists all the 100 avoidance measures that they have introduced since 2010. Over 100.
Yeah.
Over 100.
It's very useful.
Yeah, I was going to say, if you want to know everything on
Ed memoir.
Yes.
it's the place to go. So Annex 1, or Annex A, sorry. And there's also there's a report, Annex B, because in the Finance Act that's just been passed, 2019, there were two provisions in there which said the government had to report on the efficacy of the and the effect of them, of the anti-avoidance provisions actually in the Finance Act 2019. I think that was a late amendment, Jane.
It was a very late
It must have been
amendment,
very,
yes.
probably after
Yes.
1 o'clock in the morning, I
Yes,
suspect.
yes.
Because I must say, I couldn't quite see what the point of it was going to be, really.
Is there
I think it was prompted by people who were cross about some of the measures, like the time limits and so on.
Yeah, but in fact, as I read it, I don't think their report had to include anything on that. And of course, a lot of the measures aren't yet enforced because it's 6th of April.
Yes.
So if you read down Annex B, it's like, you think, well, what was the point?
It must have been a very late night amendment, mustn't it?
It must have been. I mean, it just seems
It's
pointless.
strange because usually it's very, very hard to get amendments.
Well, we're in difficult times with a minority government, of course, and
Yes.
and you know MPs are sort of flexing their muscles, but I think they flexed their muscles, but probably
Didn't read the small print. No.
didn't quite get what they were bargained for, I guess. So
Okay.
I was going to say just quickly, of course, there is another paper, No Safe Havens, as well. So that explains.
Which again is the latest version of
Yeah,
things we've seen
2014.
before.
And I think there were 3 areas in that, Jane, that they mentioned. So sort of international work they're still doing, but also compliance. So interestingly, the professional conduct gets a mention.
Yes, and the paper doesn't actually just cover offshore compliance, it covers all sorts of compliance. So again, a useful read for any practitioner to summarise the various compliance tools that HMRC has in its toolbox.
No, definitely.
Right, well, shall we leave avoidance and evasion there and move on to our other favourite subject, Frank?
Brexit.
Brexit.
Now, HMRC has been writing to businesses, hasn't it?
Yeah, so whatever we're about to say could be history, who knows. But HMRC published a press release on the 28th of February, and effectively there was a letter to the 240,000 traders who currently only trade within the EU and potentially are going to have to adopt some new procedures. 145,000 of those are meant to be VAT registered, and the government, I think, estimates there's another 95,000 who aren't VAT registered. And it basically says you need to do 3 things. I mean, we've got a little bit of time to do this, presumably, but the first thing you need to do is get an EORI number, authorised
Go on.
Come on then, what is it?
I've just now forgotten
An
exactly.
EORI number.
But effectively, it's your authorised economic operator indicator, and you can now apply for that online.
That's new, isn't it?
That's new, yeah. So that's just come in. So all businesses are going to need that if they're going to trade within the EU. So they can take 11,000 registrants a day, apparently. So
wow.
it's probably just about time for them to get these people in.
Let's hope that doesn't crash.
Well,
So is that's its capacity, 11,000 a day?
a day,
So what happens if you get more? It crashes.
I don't know the answer to
No,
that.
anyway, okay, carry on.
That was one. The other two things were get yourself a customs agent. So presumably you just get the yellow pages, and as we all know, getting people who know about customs is pretty difficult.
Yeah,
It's a very specialist area.
It is. I mean, what I would do is talk to somebody else who sells the same sort of goods as me and get a recommendation.
Yeah, no, I agree. And the other thing was they have introduced a new transitional simplified procedures for importing goods for businesses, where that business comes in through a roll-on, roll-off port. So if your goods are coming in that way, you can effectively defer VAT and customs duties when the goods actually come in, which on the face of it I think would be a major simplification and cash flow and admin.
Certainly make the
reduction.
traffic jams in Kent a bit shorter.
I was going to say. And if you're an anorak, there is a list of all the Ro-Ro ports.
And you've read it.
And, and of course I just happened to have a look at it. It's quite interesting what Ro-Ro ports there are around the
Yes,
UK.
okay.
I thought he was very quiet this morning.
So, but I mean, time is very short for all of this.
It is.
So,
And we do have some guidance for what to do if there's a no-deal Brexit, haven't we, for VAT? If you're VAT registered, then we've got postponed accounting.
postponed accounting is meant to be coming back in. And there's also the partnership pack that the government has published with all sorts of different businesses. I mean, it's very good. It's a good summary. So certainly, if you're worried about where to start, that's a good place to start.
And it's accessible from ICAEW.com/Brexit.
Yes, a plug for our Brexit hub, which
is very good.
I
It's
think
got everything on there.
Yeah, it's a really good resource.
Including the joint document that we published with the Irish Institute.
Last year.
Great. You've actually been travelling around beyond Ireland, haven't you? You went
Beyond? Well, it's not quite as far as Ireland.
Okay. In addition to Ireland, you went to Wales, because we are the ICAEW.
We are indeed.
You're involved in Welsh taxes.
I sit on the tax advisory group, and that met recently. And just very quickly, the Welsh government it's been responsible since last year for land transaction tax, so effectively SDLT in Wales, and also landfill disposals tax. So they've now had that for a year under their belt, and apparently it's going very well. But coming 6th of April is the new Welsh rate of income tax with a new acronym, RIT.
Yes.
So
It's looking quite similar to the
existing one. So HMRC have been identifying all Welsh taxpayers, which they need to do, and they're going to have a C in their tax code. And that's apparently is going pretty well for introduction on 6th of April. The Welsh Government, though, of course, because all the rates, the main rates are going to be reduced by 10%, and then the Welsh Government can effectively vary that 10%. But of course, they have decided to stick with 10%. So at the moment,
so it's
in
the
Wales,
complexity that's not complex.
it's the complexity to achieve in terms of if you're
you end
a
up with the
taxpayer.
same result you started from, don't you?
For
You've got the
now,
same figure.
for now.
Yeah.
Well, we'll wait, Frank, to hear what happens on your next journey. Can you make sure they try not to add complexity that is really complex?
Well, looking at the example of Scotland, I suspect that will be a forlorn hope, Anita.
Yeah, well. Okay, well, let's move on then to some 6th of April matters. We have been sort of looking around all the usual things that people should be thinking of in their tax practices around now. Frank, do you want to start off with some capital gains?
Capital gains,
tips?
just
Tips
to
and traps.
Just to remind people, of course, that everyone has a CGT exemption of 11,700s, and trusts, of course, have a half of that. And it's the use it or lose it, effectively, isn't it? So, if you don't, people should always be looking to try and maximise the use of their CGT exemption.
Theirs and their spouses. And remember, a spouse is only a spouse if they're a real spouse or someone that you've actually had a... brain's gone.
Not to worry. Well,
a legal joining with.
civil partnership.
Civil partnership. Thank you.
So that's exactly right. So we're no doubt all looking at this very minute.
Well, I know, but a lot of people, particularly in the younger generation, aren't getting married now. So, you know, it is worth reminding people that they need to properly tie the knot if they want to take advantage of the tax reliefs.
Yes.
I think, Jane, you said before we started, make sure that if you've got assets standing at a loss potentially, whether you want to
crystallise the loss if you can use it in the current year, or sell things which are standing at a gain if you can make use of them.
Yeah. And I suppose entrepreneurs relief, we need to mention that, don't we? So there were some changes to the qualifying conditions in relation to shares last year. So the 5% was extended to cover assets.
Yeah, I think we did that one in the last tax talk.
So I was going to say that's now come in, but also the qualifying conditions are going to be extended from 6th of April to 2 years from currently.
Yes, and that could be a killer if you've got something like a furnished holiday let that you were about to dispose of and you've only been doing the right amount of letting for the last 12 months. You might need to get rid of it rather more quickly.
Which is probably possible because you just need to have a firm contract, don't you? So if you exchange.
Yes, you do. Yes, for this particular bit of capital gains, yes. Don't forget, can't do bed and breakfasting anymore, but you can bed and ISA, and you can bed and spouse.
Yes. Gosh, what terms we do use.
I know. So hang out with the tax crowd, and it's exciting. Do you want to just mention some private company matters? Because people are going to be looking at salary dividend decisions, aren't they? At the moment?
Yes, that's right. And we were just discussing the rules about dividends and the importance if you're going to pay yourself a dividend of actually following the correct rules, otherwise it won't be legal. And the rules are different for interim compared to final dividends. For an interim dividend, the directors can declare it, the shareholders don't have to approve it, but you have to both declare and pay it in order for it to come. That's the tax point, the point at which you pay it, and you have to pay it for it to be legal, and you should keep, obviously, notes of the director's resolution. For a final dividend, that has to be approved by the shareholders in AGM, and the sort of tax point for that is when it's actually approved by the shareholders, even if it hasn't been paid yet.
And it's important that you do jot down a minute of having had your meeting, even if it's just a two-person company. I think we as tax people, we've all been to lectures where you spend quite a long time deciding on how much should be dividend and how much should be salary at the end of the year. And then you forget that you've actually got to do and keep the paperwork.
It's not so much that you forget, that my experience has often been that your client doesn't actually do the follow through. So it's probably best checking that they actually have done the paperwork correctly. And of course, as everyone knows with dividends, you can't pay out more than you've actually got profits.
Of course, distributable profits.
Yes, distributable profits, yeah.
That's a whole new area, that is.
Indeed. Just moving on, there are one or two other points about deadlines, James. Do you want to just...
the end of the tax year is a deadline for making quite a few claims and allowances. Generally, a lot of things that you can go back 4 fiscal years to make a claim for. So 2014-15 claims will drop out of time if you don't do them by this coming 5th of April. And that will be for things like allowances, the remittance basis charge, or basis rather, loss reliefs, overpayment relief, what used to be called error or mistake, all of those things you have to do within 4 years. And of course, it is easy to forget some allowances, like blind person's allowance, for example. People can be eligible for that and perhaps not know, and if they claim now, they can go back 4 years.
And for employment purposes, things like uniforms, union subscriptions.
Yes.
When you get a new client, quite often you will find you can go back a few years and get them a nice reclaim.
That's true.
Early on. What about some of the other ways that we can reduce taxable income around the year end? And one that I was thinking about is for rental income, because of course the rule for rental income now, the normal rule, is that you're taxed on the cash basis. So if your tenant's paying you a little bit late around April, and of course you won't be taxed on them maybe until the following tax year. That may be good or bad depending on what your marginal rate is, but it's worth bearing that in mind. And we were batting around the high income child benefit charge. Always. I don't think we need to go through all the rules for that again, but do remember, think about child benefit claims, have your clients made them, and think about the consequences of not claiming them and losing your state pension because of your national insurance contributions. And Frank, pension provision, that's one way of reducing your taxable income, isn't it?
Well, it's one of the few ways left, I think a lot of people might say, other than things like gift aid maybe. And so pensions. So currently you've got a pensions annual allowance of 40,000.
Yep, and you can bring forward, if you haven't used last year, you can bring forward.
Yeah.
Think about
3 years. Anyway, sorry about that. Carry on.
So there's also a clawback, of course, of that, like there is for the personal allowance when you get above 100,000. So that reduces £1 for every £2 of income above 150,000. So if you get to 210,000, if my math serves me correctly, that will take you down to 10,000, which is your
That's all
pension.
you can pay.
That's all you can pay. So it's potentially restrictive, and of course the lifetime allowance, which currently is 1,030,000, I think. Is that right?
going up to 1,055,000 from the 6th of April. Difficult number to remember, though.
Yes, so once you get there, then you're going to have to stop, and of course you'll have to bear in mind the value of any pot you've already got that might be used to pay out a final salary scheme.
It's not difficult to get to that amount if you've got a good pension scheme you've been paying into for many years.
Yes, you want to be careful. The other thing, perhaps just before we finish, remind people you can make pension provision for your children or grandchildren. You can pay the net equivalent of 3,600, which might get them into the habit of saving for their future.
Or asking you to save for their future.
I was going to say.
And they can't get at it until they're at least 55. Well, that's the current rule. So that's not a bad thing to do.
That's not changed, has it, since it was introduced?
No,
that's true.
No. I guess because that's only going to be people with surplus cash that can afford to do it. So, not a lot of options left. Perhaps just one last thing that I wanted to mention was to remind people that the large company QIPs quarterly instalment payments are being brought forward, and they're all going to be due 4 months earlier.
Which is a big jump, isn't it?
It is, yes, and it was announced a couple of years ago.
I think people have perhaps forgotten about that.
Yes, the excitement of all the other things that have been going on. But if you do want to keep up to date, then perhaps the best thing you can do is to book onto our conference. Tax Faculty Conference is, I think it's the 5th of July.
5th of July.
Yep. Is booking open for that
Yes,
now?
the web page is up and running with all the details of the programme, so people can find that through the Tax Faculty's events page, or just Google 2019 Tax Faculty Conference, I think.
And we're going to repeat last year's practical points session, aren't we, Frank? So you're
saying
you're chairing it. That's going to be the Tax Faculty's contribution to the day, things we've come across recently. We've also got 6 webinars being recorded between now and the end of April. 3 of those are for Tax Faculty members only. Please do consider joining the Tax Faculty. We'd love to have you in our club, wouldn't we?
We would.
And there are 3 that are for ICAEW members more widely. That concludes today's Tax Talk from us. Thank you very much, Jane and Frank, and it's happy retirement to you coming up,
goodness,
Jane.
I thought you wouldn't mention that. Yes, after editing TaxLine for 15 years, astonishingly, I am in fact retiring from the ICAEW at Easter.
Well, it's been lovely having you. I'm sure we're going to continue to see you. We'll get you roped into something.
I just love tax.
Well, with that, thank you very much indeed, and thank you all for watching.